following is a presentation of TFNN. Live at TFNN, the Small Cap Roundup, with your host, Kate Stalter. Now, Kate Stalter.
All right. Good morning. Happy Thursday. Starting out as we always do here. Just kind of become a tradition to start out with the IWM, Russell 2000 ETF. We're up about 0.3% right now to 83.38. That's 24 cents. You know, not terribly surprising because we are seeing all of the major indices showing some gains here this morning. Got the VIX lower, got gold higher, crude oil per barrel trading higher. So everything's on the upside today, sunny side up. Okay, so as many of you know, today is the last show here for the Small Cap Roundup, and you know, I'll talk a little bit more about this in the last segment of the show, but this was not an easy thing to do. I hadn't really talked about it on the show, but one of the things that I had been doing was pursuing some of my licensing. I recently passed the Series 65 exam, which was not a lot of fun studying for that. That took up a good chunk of my summer in studying for that thing, and frankly, all the rules and regs are kind of a tough thing to have to learn. And as a friend of mine posted on Facebook, great test to pass and then promptly forget. And he's been licensed for many years, so that was kind of funny. But yeah, that's what I spent a good chunk of my summer doing this year. How I spent my summer non-vacation, and I wasn't really sure. I had a number of ideas for things I was going to do when I originally began that process. I was intending to open my own RIA and start doing some kind of perhaps long-only trading, kind of in the style that I do here, or that Ken Shreve does in his show and his newsletter, kind of where we both came from in that Investor's Business Daily background. But kind of over the months, as I got more into the process and was talking to some other friends and researching the industry, I kind of realized I did not want to go to the trouble of starting my own RIA. And I started talking to other people and just networking and seeking some opportunities. And one of the interesting things that came up was with Lee Munson and his team at Portfolio down in Albuquerque. And some of you may know Lee if you watch CNBC or Fox. He's a regular commentator on Fox Business or CNBC. He's a regular commentator on a lot of their programs. He was just on with Maria Bartiromo the other afternoon on CNBC. So I'm going to be working with them. We're going to be launching a blog, and the URL is not up yet. It still redirects to Portfolio, but it's riggedmoney.com, so I hope a number of you follow me over there. You can follow me at Kate Stalter at Twitter. I'm over on LinkedIn. You can look me up there. A number of you have connected with me over there. So I'm around, not disappearing, and I certainly, you know, I can't thank Tom O'Brien and his team enough. Tom and Tommy and Mike and Al and Steve and Leanna and other Steve. I mean, everybody has just been so fantastic, and they're a pleasure to deal with. Good people down there in Clearwater, Florida. So it's really been my privilege, and I told Tom when we talked the other day, I said I hope there's opportunity that we can work together, keep this door open. Would like to obviously chat with you folks in the audience again, because everybody's been great. A number of you have reached out to me over the last couple days on Twitter and via email, and it's been great to hear from you. So I really have appreciated all that. So I'm actually getting a little bit choked up right here because this has just been so much fun, and I appreciate all the outreach and what everybody has said. But in any case, what I'll be doing going forward, the reason that we just kind of had to, because I'm joining up with another RIA, we wanted to keep this door open potentially if we could, but we're going to be using a tactical asset management, and what Lee already does is tactical asset allocation using ETFs, long only, to manage downside risk. And a lot of that, quite candidly, not that he doesn't invest in small caps, because he does invest in small cap ETFs. He does use these instruments, but as appropriate, of course. But it's not necessarily the case that trading lower priced or individual small cap stocks would really fit too well with that methodology, unfortunately. Now, this is not anything contrary to what I've ever said. I've always said, I mentioned this on the show Tuesday, I've always said that you want to carve out a portion of the assets you have to invest, and those are the ones that's what you trade with. I know that there's a lot of folks that don't necessarily, who are out there, who are in the media, who are, everywhere, on Facebook, on Twitter, on TV, who, I run into them a lot, who talk about trading, but don't really mention too much how you should allocate, whether a portion of your portfolio goes into some of the trading or more speculative names, or how much goes into maybe an equity overlay that you carve out, which, by the way, there is an equity overlay strategy at Portfolio, so that is something, and it's large caps, as you would imagine, but they've got some very, very good performing names in that particular strategy. So, a lot of folks, when I do speak with a lot of the traders, there's really no consideration as to how much of your portfolio is allocated to this active trading. And when I say traders I speak with, I'm really talking about a lot of folks that I've interviewed over the past couple years. And that's always kind of bothered me. Not that there's a lot of people out there that have some very good, very well thought out, successful strategies if users can apply them correctly. And I think in many cases, frankly, that is a big if, because there's not really a magic formula out there. You have to be very, very careful in how you gauge your buy and sell opportunities. I'm a big advocate of using stops. I know some traders are not. If it's the kind of thing where you are tracking the market via your phone or your iPad or literally at your desk all day long, in that case, if you are able to have the discipline and be tracking the markets all day long, and you mentally have the stops, or maybe you have them written down on a list somewhere that you can check every morning, in that case, perhaps you don't have to have the stop order in place. That's fine. But one way or another, have a plan for these stocks. And, not that it can't be adjusted. I'm that's something else that I've had a little bit of frustration with over the years, that I know when you're talking about rules-based trading, when I say rules-based, I don't mean the algorithms that a lot of the professional managers employ. When I say rules-based, I mean, maybe like a checklist of 7 or 10 kind of more qualitative rules that you might be employing here. I know there's a lot of methodologies that do that, okay? In that sense, an individual trader using a rules-based method, I know a lot of people get very, very frustrated when the art versus science comes into it. In other words, when maybe you do have to step in and kind of make some kind of judgment. There's not a magic formula. There's really not. And, I've talked to a lot of these guys that have the software programs and they'll tell you, I had one guy, this was funny. He actually told me that he had a 97% success rate with the formula, and I wasn't really in I wasn't able to kind of press him a little further on that. I mean, perhaps you can pick something that does rise a very high percentage of the time if you're going long, say, but for what period of time, for what time frame? So I guess I'm just trying to say, be careful. Be careful out there, as they used to say on Hill Street Blues. I think the biggest risks that I see traders running into is trying to impose some kind of formula on the trades and then expecting that every single time without fail you will have a winner. And, I don't think anybody out there in the TFNN family would disagree with that. Is what you're doing is, as Steve Rhodes says, mastering probability. Just kind of another way of saying that is just getting the trades in your favor, getting the odds in your favor, but also knowing that you have to have some kind of escape mechanism in case it doesn't work. Because, frankly, there's all kinds of developments that happen out there all the time. I joke with a lot of people about the term black swan, which these days is perhaps a little bit of a misnomer because you have these quote-unquote unexpected, and some of them are unexpected, events that do seem to occur on a fairly regular basis these days. We've had markets that have been exceptionally news-driven, it has seemed, over the past few years. And, of course, the ongoing European crisis presents opportunities on an almost daily basis for something to happen to move stocks up or down sharply in one direction or another. China can always rear its head, as it has again lately, with some kind of economic news or forecast or interest rate decision that has potential to send stocks moving in one way or another. So, and there's also industry news and stock-specific news. So basically what I'm trying to say here is, yes, you need to have some kind of trading method in place, whatever it is, and there's a number of trading methods that do work in the market. A number of them, and you hear a number of them here on TFNN, which is fantastic because there's a lot of opportunities for you to listen to what the methodology is that best suits your risk tolerance, your personality. But then also, and again, you'll hear all the hosts here talking about this, and it's absolutely crucial to listen to this. Have your plan in place for every trade that you make, because you can be surprised by events, and you just don't want to be stuck in some kind of downdraft, for example, if you're going long and saying, well, I'll just wait this thing out. Okay, so those are a few of my thoughts here. Wrapping up the last show today, but I'm not wrapping up, just kind of wrapping up my stint here at TFNN with the Small Cap Roundup. We'll be back after the break. I want to talk a little bit about IPOs in the next couple segments. I got an interesting email the other day asking me some of my thoughts about that from a listener. So we'll talk about that right here after the break, and I'll be right back. Stick around.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk, charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
80% of traders fail because they don't know when to get in or out of a market, and all because no one taught them how to read the signs. You see, the stock market has a universal language called Japanese candlesticks, and each day, the buyers and sellers, the bulls and bears, go to work and build signs. This language has been around for thousands of years, and it's easy to learn. I'm Steve Rhodes, co-host of the Money Masters Show, and I'm a master sign builder. Download my free report, Candlesticks, The Speed of Trust, on the homepage of TFNN.com for one of the best-kept candlestick secrets. I'll also be conducting an online course Friday, October 19th, to teach you the language of the market's sign builders. You'll learn the best entry and exit techniques and strategies that will create extraordinary rewards. The course will be archived so you can review it as many times as you like, because trading or investing without learning this language is like running a red light. It's an accident waiting to happen, and there's no airbags or seatbelts. All the details are on the homepage of TFNN.com.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
All right. We are back here with the Small Cap Roundup. Now, many of you know that one of the areas that I like to follow is IPOs. And the reason for that is, if you look at some of the best growth names really across all market caps, they often tend to be stocks that have gone public, often in the past year or two. And if you extend that out a bit more, you get names that have gone public maybe in the past 10, 12 years or so that are still top performers. They may not have that kind of explosive price growth, but if you look at some of the newer names that go out a decade or so, they often are some of those that just kind of quietly rally to new highs, continue to have some double-digit earnings and revenue growth. So in other words, there's quite a bit there that is still attracting the new customers, attracting the new investors. So that's why it's worth looking at. Now, I got an email the other day asking me what the screening criteria are. And, that's an interesting question, because it's not the case that I'm going to be looking at any new IPO as something just to jump into. Let's just for fun, let's pull up everybody's kind of favorite whipping boy stock here. Let's get that. Okay, there we go. You know what that is. That's FB. That's Facebook. So If you recall, and I know we all do, back in May, all the hype surrounding that IPO and then the debacle, it's been widely reported. You know, that's the kind of thing that everybody that day, I mean, I was getting emails from people saying, are you going to get in on that stock? Well, absolutely not. Absolutely not. You don't want to ever try to jump in on any IPO in that first day of trade. And Facebook is a pretty good illustration of why you don't want to do that. Now, you know, could this stock eventually become some kind of winner? Of course it could. You know, and that's sort of the opposite extreme, is everybody can write something off. This one, it's having its struggles, but you can see where there is some kind of business model here that could be monetized through the ads. But let's talk about another one, you know, just based on the fundamentals. I'll tell you this real quickly before I pull up another chart here. Facebook is expected to report earnings per share of 49 cents in 2012. That's down just slightly. It reported 50 cents a share in 2011. In 2013, that's expected to rise to 63 cents a share. That would be a year-over-year gain of 29%. So you're seeing some potential there when it comes to the fundamentals in Facebook. I don't use the analyst estimates as a way of making buy or sell decisions, but it is just an interesting gauge of what kind of confidence that the institutions might have in a stock at any given time. And don't forget, they're often wrong. They can be wrong to the downside as much as the upside. In other words, they can misunderestimate. I just like using that word. They can misunderestimate as much as they misoverestimate, I guess. Okay? So in any case, Facebook, sure. Could that be some kind of stock that offers investment potential or trading potential at some point? Sure, of course it could. And I'm more of a swing trader. I don't really like to, as you know, I don't really like to get in on these on a day trading basis. I really prefer to make some kind of entry into a stock that allows me some kind of more medium term, if not longer term opportunity. Let me show you another one, though, that is another recent IPO that was very widely hyped. And again, you know, just ever since, this is Groupon, went public at $20 a share back in November, okay? And as of now, it's trading below $5. You know, we've seen a deceleration in revenue growth here. Now, the company is expected to report a profit of 18 cents a share this year. That's expected to double to 36 cents a share next year. You know, again, who knows? Who knows? Is there something here that could happen that could turn this company around? Of course it could. You know, I don't like to write anything off and say never, ever, 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 but for the moment, no. There's really just nothing here. When something is this far off its IPO price, less than a year out from going public, I'm just not even going to look at this. And also, the 50-day line is below the 200-day line on Groupon. That's also not a good sign. Okay, we're going to come back and look at some of the IPOs in the pipeline and talk a little bit more about what to look for there.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. You've heard Tom O'Brien on the air, and you've seen him on Tiger TV, as well as being featured as a regular CNBC guest and contributor, and now you can have access to his expert trading advice each morning through his daily trading newsletter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, gives traders, investors, and money managers a thorough strategy for trading stocks, options, and indices every market day. Market Insights comes out each market day before 9:30 a.m. and provides traders with Tom's daily commentary, opinion, and specific trade recommendations on the markets. Using advanced Fibonacci methods, volume indicators, Gartley patterns, candlestick charting, gaps, and market timing, Market Insights will give you specific trade recommendations including entry, stop, and exit prices. The summer is over and traders are back. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. If you're a trader thirsty for knowledge, then we have the perfect event for you. Tom O'Brien will be hosting a live 4-hour dynamic trading strategies workshop on September 29th in the Tampa area. This one-of-a-kind workshop takes place from 8 a.m. till noon and is completely free. We'll even be giving away almost $2,000 in door prizes randomly drawn from those that attend live. Along with diagnostic trading expert Daryl Martin, Tom O'Brien will teach you how to identify and set up your trades using dynamic trading strategies, and Daryl Martin will teach you his diagnostic trading formula, including the strategy, system, and style that gives you an edge in this market. For more information and to reserve your spot today for the September 29th free Dynamic Trading Strategies Workshop in Tampa, please visit the front page of TFNN.com. Don't wait to act, as space is limited. Sign up today.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
All right, we have the European close here. Let's see. I just noticed that some of the U.S. indices pulled back a little bit on the European close. We've got the euro trading to the downside now. Okay, so that's what we've got going on right there. I wanted to talk a little bit about some of the IPOs in the pipeline, and let me put a chart of the IWM back up here just as kind of a placeholder, because we are going to be talking about some pre-IPO companies right now. Okay, so let's see here. What I want to talk about here, just in terms of, it's always good to look for these things, to be aware of them. Again, doesn't mean you want to try to ever jump into these on the first day. You want to give them time to develop some kind of trading character, as I was just kind of showing you there with Facebook and Groupon a moment ago. You also want to be making sure that there is some kind of potential for earnings growth. You'd want to see some kind of track record of revenue growth. It's way too risky to get in on something that just does not have any kind of revenue growth. To me, you're just playing with fire when you try to get in to one of these things, because aside from some biotechs, that is a bit of an exception to these on occasion, but other than biotechs, sometimes you don't really see the institutions tend to stick with a company when it doesn't have any kind of revenue growth or potential for earnings growth ahead. Now, sometimes there's a lot of hoopla and hype when there is potential, and I underscore that word, for earnings growth. You know, we see that a lot. It didn't just happen in 1999. It continues to happen today. But I do think when you see something like that, one of these techs, it tends to fizzle pretty quickly. I do think there is more of a critical analysis that tends to go on these days than went on, 12 or 13 years ago. So, Shutterstock. So this is, and again, I'm going to leave the IWM chart up there because it's not yet public. Shutterstock set the terms for a $63 million IPO. Now, Shutterstock, as many of you know, it's an online market for royalty-free images and videos. Very, very nice. The reason for that is a lot of bloggers will be using something like that. And a lot of these companies, even though it's royalty-free, you sign up for a subscription. You do pay some kind of fee in a lot of these cases. So there are ways to monetize these companies. Let's see. They plan to raise $63 million, offering 4.5 million shares priced between $13 and $15 per share. Plans to list on the NYSE under the ticker SSTK. The underwriters are Morgan Stanley, Deutsche Bank, and Jefferies. So that's what we have there on Shutterstock. So that's one you can watch out for. That's coming up. And again, I am not suggesting you get in on these. I'm just suggesting you take a look and see what these are doing, and that you watch the stock and you make sure that the company does have some kind of requisite revenue growth, some kind of potential for earnings growth, and you watch the character of trading. Now, very often what will happen with these, and this goes to the question of what am I screening for? Really, this is one of these cases where the rule is something you as a human being have to watch. You can't really enter this into a screening program, okay? You have to watch the stock as it performs technically in those first weeks at least, sometimes months, maybe days on occasion, but typically it tends to be at least 2 or 3 weeks. You watch that opening pop that it sometimes gets on the IPO, and I don't necessarily mean the pop on opening day. That's very typical to see if after a stock goes public, but a lot of times then it'll rise for a few weeks and then consolidate a bit. You do see some selling. Don't forget, you've got some of these lockups that go on. It's not necessarily such a big deal when it's not a huge company like a Facebook. When you have a small number of insiders that tend to sell their shares and take some profits at some point after an IPO. And don't forget, the insiders who have gotten their options at much, much lower prices, even if the IPO is quote-unquote a bomb, very often they're still in the money with these shares because they were able to get in there at a much lower price. So they still tend to sell really regardless if the stock does price below its proposed range. But even if something does price below its proposed range, we've seen this a lot recently, that the stock will tend to rally. And I'm not talking about Facebook, I'm talking about some of these other deals. The stock will tend to rally and eventually perhaps close in that day or even in the coming days above that range with a nice gain. So you watch. You can't program this into a screen. I guess you could. I don't. You could program kind of an if-then thing. If it rises to such and such a price or by such and such a percent that it pops up on your scans, you could do that. I tend to not do that, frankly. I prefer just to run a scan with recent IPOs, say between such and such a date, say January. I think one screen I have is January 2011 through the present day. I do put in that I am looking for some minimum revenue growth. You know, you can do what you want, maybe 15% in the past couple quarters, for example. And in terms of earnings growth, you want to see the same thing. I tend to look more for the estimates going forward when I'm looking at the earnings growth. And again, you might want to say maybe 15%, 18%, something in the double digits that's higher than, say, 10, 11, 12%. Okay? So that's what you want to be. That's what I do. I don't necessarily say that's what you want to be looking for, but that's how I scan for these. And then from there, I can go through and watch the charts, look how they're trading relative to key moving averages. That's very important with any stock, not just a new IPO. Not only do you want to see it consolidating after that recent pop, but then you want to see it, ideally, getting some support, above the 200-day at best, preferably the 50-day. And then, as you know, I'm looking at these shorter-term lines very often as some kind of opportunity for a trade. Frankly, those shorter-term lines come more into play when I'm looking at these more volatile market conditions that we've had in the past couple of years. If you're in some kind of confirmed bull rally and you are prepared to have some kind of longer-term holding period that could last for months or even longer, if you're prepared to sit through some consolidations, then, yeah, maybe that 50-day line could be a point that you do look at. My friend Steve Burns, who's a terrific trader, he's published a few books that are available on Amazon. I've quoted him numerous times. I haven't brought him on the show because he prefers to trade larger, liquid growth stocks. But he tends to look at that 50-day line, and if that gets support, that is a place where if the market is in an uptrend, he will enter a position at that point. And that's really nothing new. I know that you hear a lot of folks who do talk about that same methodology. Steve has been tremendously successful using that. So when it comes to the IPOs, that's really what I'm looking for. You want to make sure you have some revenue growth, make sure you have especially some earnings potential ahead, and preferably you'd like to see that met or beaten. And you also want to be seeing some kind of moving average support, buying into strength. So those are just some kind of general guidelines there. Again, it's not a magic formula. It's not just some kind of rules that you want to overlay and it's going to work every single time. You find very, very often there is the human element that goes into this. So you have to be very, very careful about that. Let me talk a little bit more about a few more IPOs here in the pipeline. Amira Nature Foods. Now, we've talked quite a lot on the show about some of these more healthy eating kind of companies. Now, this is Indian basmati rice and other snacks. You could say you could maybe call it healthier. I know they have a lot of seasonings, that kind of thing. That particular genre. They said on Thursday they want to raise $126 million by offering 9 million shares, priced between 13 and 15. At the midpoint of that proposed range, the fully diluted market value would be $470 million. So we are talking about a small cap. Plans to list on the NYSE under the symbol ANFI. And UBS and Deutsche Bank are some of the book runners on that one. So that is something there that is going public. And let me just see here. Let me just pull up the website here. This is interesting because it's based in the... let's see here. It's based in Dubai, which is kind of interesting. And I'm just kind of checking here to see what this is. So it's they call it on the website India's largest privately held company. I mean, right away that suggests that you could have quite a bit of growth potential here. So that's an interesting name that is out there right now that is in the IPO pipeline. I want to find a couple others here to tell you about. Okay, here's another one. Taylor and Martin Group. Now, this is a Texas-based company, a little closer to home. But I got to tell you something. I am geographically agnostic, by the way, when it comes to where a company is based. I'm not going to impose some kind of opinion on that. It's good to have a little bit of the story. I like the idea, for example, we just talked about Emira, that there's a large business going on there in India. That seems to hold a lot of potential, but you don't want to, again, make a judgment based on the story. You want to let the numbers prove that out to you. The revenue growth, the earnings potential ahead. Okay, Taylor and Martin Group, Houston-based company. It's one of these online liquidation companies doing liquidation auctions. That's the word I was looking for. They want to raise $165 million, offering 15 million shares priced between $10 and $12. Another small cap here. At the midpoint of the planned range, the company would have a fully diluted market value of $341 million. Company was founded in 2011, and I'm getting my information here from Renaissance Capital. And actually, I want to recommend that to you. Definitely, if you are interested in IPOs and tracking what's going on in that market, Renaissance Capital is a free site. It has a tremendous amount of information. I recommend that you bookmark that one and check that one on a regular basis. Let's see here. Company was founded in 2011, 139 million sales. 139 million in sales for the 12 months ended in June. Will list on the NYSE under the symbol TMG. Now, here's something interesting. You've got a number of the smaller investment banks that are the underwriters on this. That kind of tells you something, okay? You're not seeing the Deutsche Banks, the Morgan Stanleys, the JP Morgans, the Goldman Sachs. When you have the smaller ones, that kind of tells you a little bit. You might not have as much analyst coverage. Now, that can be both a good thing and a bad thing. In the bad sense, you may not have as many institutions jumping in. In the good sense, it could be one of these kind of stealth names that rallies without all the media hype and attention. And you could find a stock there that's performing very nicely and gives you a chance to get in there without it being under the constant microscope of the media. So the investment banks who are the underwriters here are Canaccord. I've heard of that one, but if you don't really follow the industry, you may not have. But they are out there. Oppenheimer, KeyBank Capital Markets. Okay, so TMG, Taylor and Martin, that's one that has also filed to go public. It'll be a small cap. Okay. Got one last small cap roundup segment coming up. So stick around. I'll be right back after these messages.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to check out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday, Wednesday, and Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Time is the great equalizer of all mankind. Time doesn't care about winners or losers, who succeeds or fails. Time only cares that you played the game. Question, are you playing the money game? Is your money working as hard for you as you are for it? I'm Steve Rhodes, author of Mastering Probability, a daily trading and investment newsletter service, and we're celebrating our 1-year anniversary. In year 1, we generated a 30% profit. Plus, I provided 26 hours of live coaching to my clients. My daily newsletter service is available by 8 a.m. each day and covers the stock, futures, currency, and commodity markets, along with all the current patterns that you can trade. Each newsletter is packed with education, and it's yours for as little as $3 per day. And for the next 30 days, you can try it risk-free. Click on my name, Steve Rhodes, on the homepage of TFNN.com and begin your journey to great wealth today. If you're waiting for a better tomorrow, remember this. Today's tomorrow will soon be yesterday, and your clock is ticking. Mastering Probability. Now is your time.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, folks. This is it. This is our last Small Cap Roundup segment. I really want to thank everybody. You know, I can't say enough how much this has meant to me to have the opportunity to talk to so many of you and to get so many of the great calls we've had on the air and to hear from you. And once again, to have had the fantastic chance to work with and get to know everybody on the TFNN crew. Just a wonderful group of people. And I hope these are connections to last a lifetime. You know, I heard somebody once say, it's not goodbye, it's just, hey, I'll catch you somewhere else, catch you at another time. And that's kind of how I feel about it. You know, one of the blessings of this very multi-connected world that we have now is that it does make it so much easier to stay in touch with people. We have so many ways. You know, I do not find that something like Twitter is it's not on the surface. It's not superficial. I have formed some good relationships from people I've met on there and that I get to stay in touch with. Just this morning, I've been interacting with a few folks, some of whom I know in the real world in person, others of whom I have only met online. Some of you I've met through this radio show. So, in other words, what I'm trying to say is stay in touch. I'll tell you once again, it's at Kate Stalter on Twitter. I'm also on Facebook. You can friend me there. Let's see, I'm on LinkedIn. You can find me there. Google Plus, though I kind of, that's fine. You can connect with me on Google Plus. I tend to just kind of repost things over there. I don't know how many of you are using Pinterest. I'm kind of getting into that one a little bit more. That's an interesting site. Very interesting site for discovering things. You could say it's a little bit of a maybe one of those places where you go and you get sucked in and you end up wasting a lot of time. But basically, I think the best way is maybe through Facebook, Twitter, or LinkedIn. If you want to connect with me, please feel free to do that. I would definitely like to stay in touch with you folks who are listening out there. And as I said, I have just tremendous gratitude for this opportunity to work with Tom O'Brien. He runs a very professional, classy operation over there, as you all know, not telling you anything you don't know. But I have just a tremendous amount of gratitude for Tom. As I said, Tommy, Mike, Al, Steve, the other Steve. You know, I've had a chance to meet kind of online and on the air Basil and David. And, of course, Ken and I go back many years. Our desks used to be about 10 feet apart several years ago. So all of the folks, Larry, of course. So it's just been, and in the office, Mike, Tommy, Leanna. I don't want to leave anybody out here. It's just been. Did I say Al? I hope I did. It's just a wonderful group of people over there, the staff, the listeners. And as I said, please do stay in touch with me. I want to be in contact with you. So once again, just to kind of wrap up today, it looks like we're going to wrap up the show here pretty soon. My clock is showing it's over, but I don't hear Tom Petty yet. So don't forget, use some trading rules. That would be kind of my final words of wisdom today. Make sure that you do have a plan for every trade. Don't go into something without knowing what you're going to be doing. And, we can talk stocks more. I would be delighted to. So please stay in touch and let's keep the conversation going. Okay, so peace and blessings to all of you. I wish you all much success. And I definitely hope that we can stay in touch. I want to do that. All right, everybody. Thanks again.